Today I'm going to talk about Singaporeans' favorite topic, property, and some of the factors that will affect property prices over the next few years or so. Hopefully this will be useful for you if you're a homeowner like me, thinking of whether to upgrade or downgrade, or if you're looking to get your own place in the near future. As you all know, interest rates are climbing like crazy, and this just in, the banks are increasing their mortgage packages to as much as 4.5% per annum interest. So that is really high compared to what we had enjoyed over the past few years. For a loan size of $1 million to be paid over 30 years, at 1.5% per annum interest, you're only paying about 3.5k per month. But now that it has gone up to 4.5%, the same loan will cost more than $5,000 per month to service. And therefore, you can see how rising interest rates can cause a strain on one's finances when it comes to buying a property. There are also other factors at play here, including cooling measures, old and new, as well as upcoming potential recession that might hit us. Already you can see tech companies laying off their staff, and things are not going to be very rosy for the next couple of years. So what does that mean for property? Let me go through point by point on different factors and give you my opinion on what's going to happen in the property outlook. As with most investments, there are people who are bulls and very optimistic on the outlook of that particular investment class. And then there are always going to be bears who are, Debbie Downers and always saying that, okay, this particular investment is going to go down, right? It's the same for crypto, it's the same for stocks, it's the same for property. So let's look at different factors at play and see whether the bulls or bears make more sense, at least according to my own opinion. Since this is the most noticeable thing that's happening right now, let's talk about interest rates. And bears are saying that rising interest rates will cause borrowing costs to be too unaffordable and people will start to sell their properties or not buy properties because the cost of borrowing is just way too high, as you can see from the example I raised earlier on. Now the logic is quite simple. People take out a loan to buy an investment and then earn the arbitrage between the returns that the investment product gives it and the interest costs of their borrowing. So when interest costs go up and your return cannot match the interest costs, you start to lose money and then you will give up the investment. Now, I think this criticism is quite applicable to leverage endowment, where you buy an insurance policy, a savings insurance policy, take out a cheap loan, what used to be a cheap loan, to service that policy, and you gain the difference. Now that interest rates are coming up, I think people who have bought leverage endowments are now feeling the heat and thinking of whether or not to terminate their policies, things like that. But when we talk about residential property in Singapore, however, most of the time we buy property to live in it, and also a secondary purpose will be for investment purposes. So when interest rates go up and mortgage increases, am I going to offload my house? It's very unlikely because I've grown accustomed to staying here and I don't want to move back to my parents' place. And I'm someone who can actually just sell my property and then go somewhere cheaper to stay. But what about people with families, with children? They are not just going to sell their properties and then uproot their entire family just because mortgage rates are increasing. So I think that while mortgage is really going to get more expensive, I don't think that homeowners right now will definitely sell their properties just because it's more expensive to service. They're just going to cut down on other expenses and prioritize mortgage because roof over their head is one of the most important things they have to pay for. For aspiring home buyers, I again think that rising cost of borrowing will not affect their decision too much because it depends on their purpose of buying the property. If it's for family stay, they're unlikely to abandon their home buying plans just because cost of borrowing has gone up. Maybe they'll pick something less pricey. And I also think that property is always going to be a very aspirational thing to have in Singapore, and therefore will not deter too much of those who just want to buy property just as a milestone of their lives. However, property as an investment class, I think will obviously be a little bit less attractive, especially when rates are high in other areas. You can just get 4% easily now, risk-free. So will people put money into property? I think for the short term, it is very unlikely. Longer term, I don't have a crystal ball, but I tend to feel like property trends upward in Singapore. It is inevitable in a landlocked country like us. At the end of the day, let's not forget that Singaporeans are also quite flush with cash. As you can see with TB applications, with SSB, there's a lot of money floating around still, and they might not need to borrow that much to buy property anyway. For your first property, you can borrow as much as 75 to 80% of your property value, but subsequent properties, you can only borrow about half, and therefore, very rich Singaporeans might not feel the pinch of the rising interest rates when they don't borrow so much in the first place. So when it comes to rising interest rates, I think I'm going to give it to the bulls here. I don't think that the current high interest rate environment will actually affect property that much. Even if property prices were to stagnate or go down, I think it's going to be temporary. In the long run, interest rates probably wouldn't remain so high for a extended period of time. Again, I have no crystal ball on that, but it tends to trend upwards, and I would again think that long-term investment-wise, property is still pretty sound in Singapore at least. This video is brought to you by Weeboo, which is giving you an all-time high of $150 when you sign up for the account, deposit $2,000, and make a couple of trades. This is the best sign-up offer they have given to date, and you also enjoy features like fractional trading, which allows you to trade from as low as $5 per trade, and there are no commission or platform fees currently. So an excellent way to start your investment journey with free money, right? Very low trading fees, and also you support this channel. So thank you for signing up, and thanks to Weeboo for sponsoring this video. Now, the next factor I want to explore is cooling measures and whether or not cooling measures will cause property price to stagnate or go down. Cooling measures have been introduced more than 10 years ago to temper the property market in Singapore, and the latest further tightens loans as well as prevent downgraders. You can see my latest video on property for more information on that. And therefore, it makes it more difficult for people to buy property, and the theory is that it will make prices not go up that much or even come down depending on the market's response to the cooling measures. Now, we have had rounds of cooling measures, and property prices continue to climb over the past decade or so. So I think cooling measures does prevent property prices from surging too much, but the trend going upwards is very clear, and property price continues to go up. And the latest cooling measures weren't even that devastating to begin with. I think it's just a slight tightening of loan eligibility as well as preventing people from downgrading. In fact, a lot of people are questioning that cooling measure, whether or not it will actually drive rental prices up, because downgraders will rent for 15 months and then go and downgrade to HDB anyway. So we'll see how that plays out. But in my opinion, cooling measures just slow down the growth of property prices, but it still continues to climb and therefore remains an attractive investment asset in my opinion. In fact, it can be said that cooling measures in the past decade have helped to stabilize property prices because buyers have passed their TDSR, LTV, things like that before they can buy the property, and therefore have the financial ability to go through market downturns and stuff. And there will not be fire sales, there will not be people panicking and selling their property as much as before. And as someone who started my property hunt 5 years ago and bought 3 years ago, I can roughly attest to the fact that cooling measures, while it is quite bad for home buyers, it's just something that we will try to overcome eventually, because home buying is just that attractive and aspirational. So on the point of cooling measures, I have to give the bulls the win again, because I just don't see how the cooling measures are going to dampen property prices that much. One major factor that will affect the property market would be a potential recession, and it's getting likelier and likelier that we are entering a recessionary period. And companies like Shopee, Meta have been laying off workers, and other companies going on hiring freezes. And when you have no income, I think you probably wouldn't want to buy a home or property, and therefore it will affect property prices as demand goes down. Even those who are not directly affected by layoffs may be more cautious when it comes to big ticket items like buying a property. And therefore, I think the next year or two might see less demand for properties as people start to become more conservative and hold off their purchases. There's also this argument that in the past few years where things were very rosy and people had high salaries, they bought properties that were expensive, over leveraged, and now, right, reality is hitting, pays are coming down, or they are losing their jobs, and therefore the prices of this kind of properties will go down as demand shrinks, and in fact more distressed sales happen. In this regard, I think there's a significant chance that property prices may come down quite a lot, depending on how bad and protracted an upcoming recession would be. So I'm going to give the point here to the bears. So overall, I feel, based on my own observation on all these factors, that property in the short term, maybe 1 or 2 years, will actually see stagnation or actually go down slightly, but in the long term should still continue its upward trajectory as it has always been before. But that's just my observation. It is not financial advice. If I were a home buyer right now, I'll ask myself a few questions. I'll try to clarify my goal for buying the property. Is it for my family to stay in? Is it for investment purposes? Or is it just to achieve a certain aspiration? Number two, I will look at whether or not, okay, I am over leveraged. How secure is my job? Am I able to pay mortgage if the interest rates continue to be high for the next few years or so? And number three, okay, whether or not I can get something cheaper as opposed to something more pricey. Okay, I think this is the time for people to be a bit more prudent. You never know when things will go south in your sector, and maybe the job that you thought was quite secure actually isn't that secure after all. Yeah, but I'm just a bit more conservative like that. And as a homeowner who is going to meet the 3-year mark and therefore be absolved of seller stamp duty, I have three main options moving forward. And number one would be to actually sell the property and upgrade and buy something pricier. Now, this will be a very bullish move and something that I am actually considering, but it's a bit scary right now. So I will still sit on it. I think this I will elaborate more in a separate video. Number two, I can do a very bearish move and sell my property right now, take the profit, and then go back to my parents' place to live. Hi, mom and dad, if you're watching this. Or number three, which is to do nothing and to stay at where I am right now, because thankfully I've already refinanced my mortgage earlier this year at a rather attractive 1.45% rate fixed for the next 2 years. So at least for these 2 years, I'm pretty much sheltered from the crazy interest rates, and I can still afford it. My job's doing fine. Yeah, so I can stay put, and that I think is the neutral position. Not that bearish, not very bullish as well. So yeah, I just feel like property will continue to rise as long as I can ride through these few years, and then I see how it goes. So by staying put, I think I can sit back and observe what's going to happen in the market over the next 1 or 2 years. If markets crash and property prices all go down, actually I think that's a good thing for me, because I might lose money on this property, but my next property purchase will be highly discounted, and therefore overall I still am better off than buying right now. And if markets continue to rise, then I think I have more confidence to move forward and upgrade, because yeah, if high interest rates, if cooling measures don't prevent this property price monster from growing, then I think very few things would. But of course, let me know what you think in the comments below. If you like my content, do drop me a like and subscribe to my Telegram group for related content and great deals. And if you want to find out more about the cooling measures that happened a few months ago, check out this video, and I'll see you in that video. Click it now.